3, 2, 1. Welcome to the podcast.
All right.
We have little digs here.
Yep. It's moved into a new place. It's a little bigger. Got some new art on the walls.
We'll have to do like a little tour video, and show people around. We got a whole different office and a podcast space that's we're working on. We'll get a little decorated and we'll look cool.
Yep, it's looking good so far. We got a new bull and a new bear up there.
Yeah, they're fancy.
Yeah, and neither one of them is rolled over at this point. It's a duel between the bulls and the bears. The market has been crazy.
I wonder if we can get them to fight each other.
They're fighting each other.
That's how it is in the market.
It is for real. Last week we did the interview with Jim Bartoloni.
Yeah.
Hopefully people got to watch that. It's definitely a different kind of come to than what kind of the tools that we use here, but I definitely incorporate a lot of the stuff that he does. And he talked about Tesla and Pfizer at one point in that, and he pinged me today and he's like, because I told him that we were putting the video up last weekend. And he's like, hey, great. Good to be on with you guys. And by the way, Pfizer hit 40 today. So I pull up the chart and I'm like, So I'm doing Pfizer as like a bonus chart at the end.
Oh,
so
cool.
If you want to stick around for that and see what happened with Pfizer.
Stick around, man. I always stick around.
Yeah, well, you got to stick around.
I'm not going anywhere.
All right. So what we're going to take a look at today, we always have a lot of new people. And so we're going to kind of go over what are the components of the three stock funds. I'm not going to deal with the F fund today, just the three stock funds. And then kind of how we make reallocation decisions in terms of being in the funds that go up the most. So this is probably last on my list of when I kind of make reallocation decisions. The price has to go through the 20-day moving average line, and the RSI has to turn up, and CCI and MACD and all the rest of it. And then you make a decision that you're going to reallocate, let's say, into the stock funds. Then you look at where you are in the month, because you only get 2 moves a month. So you want to look at the tactics around that. And then the last thing that I kind of consider is, do I want to reallocate evenly into the stock funds? Or is there a reason to do like 100% C or 100% S, or some combination other than evenly distributed between the three funds? So and the way you do that is you look at the charts relative to each other. So we're going to take a look at that. And then the TSP fund charts, and then I have 2 bonus charts at the end. Okay, so the C fund. I took these from the TSP website, okay? The C fund's investment objective is to match the performance of the S&P 500, right? It's a broad index made up of stocks, the 500 large to medium-sized U.S. corporations. So basically you look at it as, it's not 500 either, it's a little bit over 500 right now, I think. But it's basically the 500 largest companies in the U.S. And so as of the end of 2022, these are the top 10 holdings in the C fund. Okay. So Apple, Microsoft, Amazon, Google, Berkshire Hathaway's in there, but the FANG stocks have been making up the majority of the C fund for a long time. So when tech goes up, the C fund tends to go up. When tech goes down, the C fund tends to go down. And then as tech loses value, it becomes less important to the C fund on a relative basis. So the bottom one, so these are the top 10, the bottom 10, let's say, if they start improving in price as the top 10 come down, the mix can change, but the price of the overall index can go up or can go down. So hopefully that makes sense. But still, the C fund is dominated by tech. You got 2 Googles, and Apple, Microsoft, Amazon. Netflix used to be on there, but it collapsed so bad last year. It's nowhere near in the top 10 anymore. But anyway, you can see how important the tech sector is to the C fund overall. S fund. A lot of people confuse the S fund because it says it's the Dow Jones. It's the Dow Jones U.S. Completion Total Stock Market Index, right? A really goofy name, but people confuse the S fund with the Dow Jones Industrial Average.
Yeah, very, very different things.
Very different.
Not even remotely close.
The Dow Jones Industrial Average is 30 companies. It's the original index created by Charles Dow.
The OG.
The original OG, yeah. And so he actually was also the guy that started the Wall Street Journal and a whole lot of things. But do not confuse the Dow Jones Industrial Average with the Dow Jones Total Completion Stock Market Index. They're definitely not the same. So the S fund is essentially, there are basically 5,000 stocks on the U.S. market. The S&P 500 is the top 500. The Total Completion Index is the other 4,500.
Right. Everybody else.
Everybody else.
Right.
Okay. Yeah. Basically everybody else. The Dow Jones Industrial Average is 30 big companies. Generally not tech. They're industrials. Okay. Nothing to do with the S fund. And to confuse it further, you would think Dow Jones Industrials, maybe it would be DOW. It would be Dow. So if you put Dow in the ticker symbol, it's Dow Chemical.
Right. The company.
Okay? The company.
Yeah. So
it's confusing. Dow Jones Industrial Average, it can be, depending on which software you look at, you can DJI sometimes will come up as industrials. Composite is the NASDAQ. I'm trying to remember the other way they do it. Anyway, don't get it confused. The Dow Jones Industrial Average and the S fund is not the same. Yeah, sorry about that. So the S fund, top 10 in the S fund, Blackstone. If you guys don't know about Blackstone, you definitely should, because they are the company that is buying up all the residential real estate and making it impossible for everyday homeowners to not have to bid up the asking price, because Blackstone is buying everything in sight. Uber, obviously, Palo Alto Network, Snowflake. So a lot of these are the smaller tech companies. S fund tends to be primarily tech, but it's not like the FANGs. It's smaller tech, so it tends to be more volatile. I fund. The objective is to match the performance of we call it the Europe, Asia, Far East Index. I've never seen it written anywhere else other than on the TSP site as the Europe, Australasia, Far East Index. But EFA is how you would always EAFE, but EFA is the ticker symbol. And so with all these, the objective is to match the performance. Okay, it's not exact, and I see a lot of times on Facebook people would be like, "How come when I look at the iFund it was down a little bit, but the EFA is up a little bit or whatever?" Right. It's not exact.
Yeah, it's just close.
Close.
And I mean it rattles my brain a few times just to think like, well, how are you tracking it? Well, there's computers involved and people and lots of things going into making sure it tracks, but it's still not going to be like
it's
second to second for sure.
It says the objective is to match the performance. So
right.
By definition, that objective means it doesn't match the performance. It's trying to get as close as it can. Mm-hmm. So it's going to be off, right? But the EFA is the best ticker symbol you can use other than putting the actual numbers from the iFund into a spreadsheet and mm-hmm. building your own chart and all that.
Yeah, which you could do. I mean, if you do that, you get basically a closing day price. You get a line. Yep. You're not going to get candlesticks.
Right.
Like that's why we use the ETFs that we do, so that we can get candlesticks, so we can see a lot more information about what happened in the day. At the end of the day, you could use the same methodology that we do mm-hmm. with just closing prices and a line.
Yep.
Right, a line
absolutely.
Graph. Yeah,
yep. That's how I learned how to do it.
Yeah, and it works
on chart paper.
But you've got more information if you do it the way we're doing it here.
Yeah, and it's much easier. You can if you're on TradingView, you can slide back and forth, and you can expand the time and contract mm-hmm. and all that. So use the tools, but it's not going to be exact. And the iFund, you can see Nestle, AstraZeneca, Shell. There's a lot more energy in the I fund, which is why it did a lot better last year than the C and the S funds. It's a completely different kind of index, and we're going to see that on the chart here in a minute. So reallocating between the funds, right? The way we do it, the S&P 500, our C fund, it's the proxy for the market. So generally, if the C fund is going up, the S and the I funds are going to go up with it. We use the C fund as basically the proxy. So the first thing you ask, is the C fund in an uptrend, right? Are the S and I funds also individually in an uptrend, right? Because if they're going opposing each other, you don't want to be in a fund that is trending down when you could be in a fund that's trending up. And then what's the long-term trend of the S and I relative to the C? So we're going to look at that here in a little bit. All right, so the C fund, this chart of the C fund goes back to 2001. Price is the black line, and the blue line is the 50-week moving average. So at the close of every week would be a dot, and if you connect all those dots together, that's how you get the black line. So it's weekly closing prices. And you can kind of see from the chart, for one thing, let's just say since 2009, clearly we're in an uptrend. Okay, a long-term uptrend. This is not day-to-day looking at it, did I lose a little bit here or gain a little bit there? In the big scheme of things, we're in an uptrend. Even though we had this 20% down move, we are still, in this channel. It's an uptrend. And this was a bear market because they say a bear market is a 20% decline in the stock prices. So that was a bear market, quote unquote. But it's not. The trend isn't down until you get lower highs and lower lows, and we don't have that on this chart, right? So long term, we're in an uptrend. If we if we connected these lines and we close down here somewhere, which there are some people that are calling for, that's a big problem. If we get down below the COVID low, things are much different on a very big time frame. But for right now, we're not there. So anyway, that's the way the C fund looks, right? It's in an uptrend clearly since the low in 2009. S fund doesn't look all that much different, right? We had this big blow off top after COVID. But other than that, the S fund doesn't really look all that much different. And after this blow off top, we're really, in this really good channel. So we had an overshoot on COVID and this blow off top after COVID, and now we're back into this same channel that we've been in since 2009. So it's just to put some perspective in this overall kind of market from a long-term perspective. I fund, as you probably would expect, looks completely different than the other two because the industries are completely different. The sectors that make up the fund are much different than the C and the S funds. And so we've talked about it before. The S fund or the I fund, since the low there in 2003, way outperformed the C and the S fund. And then it crashed, right? But it's still in this relative up channel, right? So, okay, how do we decide? We went through the process of, okay, the market turned, it's confirmed because we're looking at the C fund in general, and the C fund's going up, and the S fund's going up, and the I fund's going up. How do we know which ones to be in? So this is a relative chart, okay, going back to 2002. So the black line is the I fund in the numerator and the C fund in the denominator. Okay, so it's a chart of the relative value between the I fund and the C fund. And then the orange line is the relative value between the S fund and the C fund. Okay. So like we said, the I fund was way outperforming the C fund, and the S fund did also, but the I fund was way outperforming the C fund. So how do we know that? Because it's on a percentage basis. If the let's say S fund, right? I fund. Let's start with this one. So the I fund is the black line. If the I fund is performing the same as the C fund, you're on that 0 line, 0%, because there's no difference between the two. So when the black line is rising, it means the I fund is outperforming the C fund. Okay. And then when the black line is declining, it means the I fund is underperforming the C fund. Okay. So what you're trying to look at in these long-term charts is a divergence. So right here, you have a huge divergence between the I fund relative to the C fund goes down, and the S fund relative to the C fund goes up. So if you keep an eye on these charts, kind of on a monthly basis, you don't have to do it's definitely not daily, because most of the time daily they're all kind of moving in the same direction. But over time, they get these divergences, and if you could have been out of the I fund and just in the C and S fund, let's say, somewhere in here, you wouldn't, on a relative basis, you'd be way better off in the S than you would be in the I, right? And then the C is sort of flatline in this example. So that's how you would do it. If everything's going up, relatively together, then it doesn't matter. You can be in both of these funds. Obviously, if they're both going down, right? If the S is going down and the I is going down, it means the C fund relative to those two is where you want to be. Now, if the C fund is going down itself, it doesn't do you any good, because you don't want to be in funds when they're going down nominally, right? And you want to be in the funds that are outperforming the other funds.
Right.
So this is how you would, but again, this is like the last thing on my list of important things.
Right, but this does come into play when we do the kind of balance across the funds, maybe a 30-30-30 kind of thing, right? I do get that question every once in a while, right, where people are like, hey, what made you do that versus 50-50 or right. All in? Well, it's because relative to each other, the two might be going up together, and so in any given day we don't know exactly. Right. So you're probably better off just being in both even amounts, but it's still a little bit of a risk because you don't know, right? But what we're doing, that's what you use to kind of figure that out. Now, if they're, as this chart shows, they're completely going in different directions, well, obviously, that's when we reallocate and go all in on the one that's going up and get out of the one that's going down. Right.
That's the idea.
Yeah.
And you can use, we've talked about the dollar and how important that is with respect to the I fund. So if the dollar has just rolled over from a long-term top and it's headed down, chances are the C fund is going to outperform the I fund, because the I fund, actually that's the other way, when the dollar is going up. Yeah.
Right, the other way.
Yeah. So if the dollar is breaking out to the upside, the I fund is going to be going down. Things like that. Interest rates. When rates go up, it affects tech more so than other sectors.
Which is going to be in the C fund.
Which is the C fund. So that's why the C fund kind of can outperform or underperform. So if we zoom in, actually, this is going back to 2020, and we had the October low, right here, and we had the rally, and since on the rally, the I fund and the S fund are outperforming the C fund. Okay, so you'd have been better off 50-50 S and I. You'd have been best off 100% I fund, but you'd have been better off 50-50 S and I and not having any C fund since that October low. Right? Does that make sense? And then the other way you're kind of looking at it is, this isn't let's go back to this one. This isn't enough of a trend change for me yet, but if the charts over the next year or so starts doing like this, the I fund is clearly outperforming the C fund, right? And it could be the same with the S fund. If the S fund starts doing like this and the I fund's doing like this, you don't want to be in the C fund, So, and you would, you draw the trend line, and when it breaks maybe it breaks, comes back and tests it and keeps going. And if that's where you're at, you want to be in the I fund. Right? And on a shorter term basis, it looks like that's the way it's going. So we'll see. All right. You think that answers generally how do I reallocate between the funds?
Yeah. I mean, I can see it. I mean, hopefully we're getting it across to other folks. I mean, I think sometimes this is when certain people will glaze over.
Yep.
Because they're just like, I'm not there yet. I'm not there yet. Like, get me back to the 20-day moving average, right? or whatever. And I feel that, right? Like, I get it because when I first started trying to make this transition over to, to doing technical analysis, at least at a basic level, at some point, even though this is not really difficult to understand, it does become difficult to apply. Meaning, if I didn't have you. If I couldn't look over your shoulder, which is why we do this, right? So you can look over our shoulder and go, oh, okay, I got it. But you do want to get to a point, where you can see it yourself. I think it's worth the effort to see it yourself. And again, you may have different risk tolerances. You may have different viewpoints in your position in life and whatever. Right. And you might make your decisions differently and very well may outperform us.
Sure.
The only way is once you've done it and you can see. And what I'm starting to tell people to do is do something similar to what we've done, which is, you can open up an IRA or a brokerage account or something in like Fidelity or in, I would say use something like TD Ameritrade because you get Thinkorswim with it, right? And now this is getting really, it's getting real techie kind of whatever, but they'll give you access to, and I think TradingView does it too. So maybe you don't even have to open an account. Right. But the point is I know that Thinkorswim does it. I'm pretty sure TradingView does it, but it gives you a play account, like play money. And so what you can do is, manage your real account, maybe like we're doing, right? Your TSP, right? And then you go, okay, well, what if I did this? Well, you can do the what ifs in your fake account.
Yeah.
Right? I think it give you like 200,000 or something, right? So something like that. Yeah. And so you can test these things. Yep. And if you're really interested in figuring this out, that's what I would recommend. And I this is what I would say: take a year, follow along with us, and then have your fake account. Mm-hmm. And make your tweaks and say, well, what if I, and see how it goes. And you'll learn a lot more that way, I think.
Yeah, for sure. No, that's a great idea.
Well, thank you. It comes out every once in a while.
All right, TSP fund charts. So this is interesting because we are recording this after the close on Thursday. So it's going to be interesting to see what happens on Friday, tomorrow. But this is a 3-year chart of the C fund where each one of these rectangles, we call it a tick. Each tick is 1 week of price movement. And the blue line is the 20-week moving average line. And then you got the relative strength indicator and MACD oscillator. So it's pretty clear once we got back above the 20-week moving average line after COVID, every time we corrected a little bit, came down, found support at that 20-week moving average line until the beginning of January 2022. And ever since then, we've had a very hard time. We've gotten above that 20-week moving average line a couple times, but have not been able to sustain it, right? So where we are right now is right on the cusp of support at that 20-week moving average line. Literally, we are right on it. If you guys have looked at, I did a market update last week in the members only group, and then I shared it to the public group. This is the 200. I think I did a daily chart, but it's the same kind of thing. This is the 20-week moving average line. If you connect the tops, all these the tops had acted as resistance all the way along, and we broke through it, and now we're coming back and retesting it. So now this downtrend line should act as support. And you get the 20-week moving average line, and if you look at it on a daily basis, you get all kinds of other lines that are all in there that ideally will provide support for price. And for the past week or so, the market's been up and down along that 4,000, say 39.75 to 4,000 level, and it's just banging around in there. So we're going to find out here pretty soon, one way or another, which way it's going to go. Today, Thursday, was a huge up day, and that brought us back to basically even for the week. RSI right there at 50, MACD right about to cross down negative. So the value of knowing where you are in space, basically, on this chart, is that if RSI stays above 50 and MACD stays positive and we stay above that 20-week moving average line, chances are the market goes higher. So what you would do basically, let's say you reallocate it to the C fund here. I'm not saying you should do this. I'm just saying this is what you would do. If you reallocate to the C fund here, it's right on that line. If it breaks below that line, that's your risk. And your potential reward is, I would argue, the August high. I mean, that's 4,300, 4,400 maybe on the upside. There's a lot of people that think we're going to get up to here before the next big down leg. Which you don't even have to worry about the next big down leg, because all that matters is if support here holds and you were in it, you'll get whatever highs you get until it rolls over, and then you'll get out again. So this is an area where you can get in with minimal risk because it's identified. So hopefully that makes sense. I'm going to look at one of the bonus charts, and I'll talk about that again in a little bit. S fund, same thing. As long as you're above that 20-week moving average line, you're good, right? Until it breaks to the downside, and then it's resistance, a little overshoot, but basically resistance. And now we got back above that 20-week line, and we're right back to support at it. RSI just above 50 and declining. MACD is still positive but declining. So we are right on the cusp. iFund, a little bit different. We said you would be better off if you were in the iFund from the October low. That's what it looks like on a daily basis, right? It had this huge explosive up move from that October low. And it basically came because of this huge decline in the dollar. And so if you look at a dollar chart, the dollar has bottomed and has started back up. And so that's where we're getting this decline in the iFund. But we're above that 20-week moving average line. RSI is above 50, and as of this week, it's starting to turn back up, and MACD is declining, but still positive. So the iFund is still in pretty good shape, but it does have some room to get down here before it finds support at that 20-week moving average line. F fund is kind of interesting because, first of all, it's the worst looking chart, right? Obviously, there was no jump today. So we're below that 20-week moving average line. We had gapped down below it last week, and it's continuing lower this week. RSI is below 50. MACD is just about to cross negative. So there's nothing good about the F fund right now. But what's interesting is that the expectation was, maybe still is, that the stock funds would collapse. This was the industry consensus at the beginning of the year, that stock funds would collapse in the first half and people would flee to the safety of bonds, which would mean if the stock funds collapse, the F fund should have moved higher. And we're seeing the opposite, right? As of today, we're seeing strength in the stock funds, and the F fund seems to be collapsing. So definitely the opposite of what people thought, number one. Number two, all since the beginning here in 22, which was why 2022 was such a bad year, the F fund is collapsing along with the stock funds. So if you overlaid a chart of the C fund and the F fund, they basically come down and go up and come down together. I mean, that the bottom in the F fund was the October low. We had that recovery rally just like we did in the C and the S funds. The stock funds were rolling over, just the F funds rolling over. I mean, they're working in tandem. At some point, they're going to diverge, but they're still going in tandem. And I just think this week is a little odd that if the F fund continues lower this week and the stock funds start moving higher, that's going to be completely inconsistent with any of the macroeconomic stuff that's going on in the world. But if that's what's happening, you'll see it on the chart. And believe me, the people in Bloomberg will come up with some kind of reason why it is what it is. But, we talk about that ad nauseum.
That's because they got to talk.
They got to talk, and they're good at it. They talk. Okay.
They got to fill 24/7. We only got to fill like 45 minutes.
Could you imagine?
No, I can't imagine. It just exhausts me.
Yeah, I can't even imagine.
I don't want to.
Nah, no way. I talk about all this stuff for 4 or 6 hours over my shift is a day. All right, 2 bonus charts. So we were just looking at the C fund on a weekly basis, right? So here's an 8-month chart of the C fund where each tick is a day. Okay, so each one of these is 1 day of price movement. The blue line is the 200-day moving average line. Okay, it's a really important support and resistance line. It was acting as resistance all the way along. We got above it in early 2023, rallied a little bit, and now we're coming down, and we're at support right there at that 200-day moving average line. And then today, it's a little bit hard to see, but I'm going to try to zoom in. Today we have this thing that's called a bullish engulfing candle. Okay, so I can't write and zoom in at the same time, so I'm just going to kind of talk you through it. The bottom of the rectangle, so in the candle, you get the white body of the candle. So we're looking at today's price, right? The last price on the chart. The bottom of the white rectangle is where the market opened today. And it went a little bit lower. You can see the line goes a little bit lower. And then it reversed and got all the way back up to almost 4,000, right? So it closed at 39.81. So it engulfed all of yesterday and all of yesterday's price movement. It went lower than yesterday and higher than yesterday, and it closed, the body of the candle engulfed yesterday's body of the candle. And it happened right on that 200-day moving average line. This is really bullish. It doesn't mean that the market's going to be off to the races. This is going to, we're going to need to see some confirmation. But this is a really, really bullish sign for at least in the short term for the market. So we'll see what happens tomorrow for sure. And then what happens, going forward until the Fed meets, I guess, I think it's March 22nd. But that's going to be really interesting in the Fed meeting. So anyway, on a daily basis, this is definitely something to look at. The last time we saw a bullish engulfing candle, I mean, this is the best example. It was the day of the bottom in October, right? That's a monster reversal bullish engulfing candle. And you don't see it very often. So I'm just pointing it out. Okay. So last one, if you guys watched the show with the interview that I did with Jim Bartolini last week, he talked about Pfizer and Tesla. And so I'm just going to kind of go over what he was talking about in Pfizer a little bit. He uses these things called measured moves, all right? So the dotted line, these 3 dotted lines, they're all the same. They're the same angle, the same length. And so all I did was draw the line from this top to this bottom, right? And I copy pasted the dotted line and put it to this high. And it's basically the same. So the market recovers off the low, comes down, takes a while, but this was actually 40 and it got down to 41. So it's not exact, but it's pretty close. Then we get a recovery rally again, right? And from the top down to where we closed yesterday was right at about $40. And then today we had a big reversal off of that $40 level. So there's no guarantees that, Pfizer doesn't keep going down, but measured moves are a really, really strong tool. And the beauty of it is, if you were to buy Pfizer down here at 40, it closed today at 40.62. So if you bought it at 40.62 and it it rolls over and it closes below 40, that's your risk. But your potential upside gain is at a minimum, let's say 52, right? Because now you're just doing measured moves on the other side. So that's kind of how you would use measured moves. If you don't know what it is and you kind of like the idea, definitely go back and look at the video from last weekend. We talk about a whole lot of different things in there. Tesla, he nailed Tesla at to the tick, and that was a great play because I think Tesla went down to like $100, I think right around 100. And then you can see clearly in the chart where it came back up, hit resistance and rolled over. It was off like, I don't know, I didn't look at it today exactly, but it was down 5% in the pre-market. So there's a lot of upside resistance on Tesla right now, but it's at like $150. It was a 50% move at least. So it was a really good trade. So the measured moves definitely work. They're not 100%, but they enable you to get in at a place that you can identify your risk, and that's really the most important thing. So go back and check out that show. All right.
You really confused
Questions?
me.
I confused you?
Because you usually do the bonus charts in the middle, and then the weekly charts at the end, and I was like, oh, are we done? No, where do I? Hey.
Got to keep you on your toes, bro.
You did, man. I was like, I can't even drink my bourbon. What? All right.
You can't say that word.
No, I didn't say it. I cut it out.
Okay,
I bleeped it.
Bleep. Essential water.
All right, guys. As usual, if you have any questions, the best place to put them is wherever you find this video. Find it on YouTube, comment section, Facebook, comment section, wherever you find it. If there's not a comment section, just shoot us an email at support@growmytsp.com. The support team will shoot it over to us, and we'll do our best to answer it, unless it's about your personal financial situation, and we won't do it.
Can't do it.
Other than that, I hope you guys like the new setup. We're gonna get some groovy little things on the set. Work. Yeah, we're trying to step up our game, keep you guys interested, and also now we're not cramped over in the corner in our old office, and so it's nice to breathe a little bit.
Yeah, this is way better.
And Chewy's got more room to run around. She's sitting here by my feet. All right, guys, thanks for joining this week, and we will see you next week.